For watching. I'm working more today on my stock market strategy. I work on this every day, so if you think this is interesting, subscribe and follow along. Like the stream, of course, that helps me too. Before I get into things today, I'm going to go over the goals, the general goals for the project, what I've done so far, what I've done recently, and what I'm going to be working on today, and then I'll get into it. So, this is the outline for the project. I have two goals. First goal, beat the S&P 500 by a significant margin and stay market neutral. So the S&P 500 goes up on average 6% per year. I want to do 3 to 4 times better than that and return on average 18 to 24% per year. And I want to stay market neutral. So I want this strategy to work regardless of whether the market's going up, going down, if we're in the 2008 financial crisis, if we're in the COVID crash. Regardless, it should make 18 to 24% per year. Now, this is the layout here at the bottom. So you're starting with data. You don't want to use all data for the stock model. Not all assets move the same. For example, common stocks like Apple and Tesla are going to move different from sector ETFs. So I'm only using common stocks, Apple or Tesla, REITs, real estate investment trusts, and ADRs, which are foreign companies listed on the U.S. stock market. I'm excluding things like penny stocks. I'm trimming out everything that's not in the top 2,000 by volume. Basically, you want high volume stocks. That means the model's scalable. If I'm able to get a really good strategy, I can sell this to quant firms. But it also means that all of the assets that I'm training on move the same. So once I isolated a stock universe, the next step was feed this into a returns model. This is predicting the return of the stock, return relative to the market, the sector, the Sharpe ratio, the probability of a positive return, something like that, and you're looking out into the future. 1 day, 5 days, 20 days, etc. So I've got a really good model going. I'll show that in a second. And once I have a really good model, the final stage is building a portfolio strategy based on that model. So take the model output and use that along with some best practices to decide how to allocate capital in a real scenario. So I'm writing all of this code in Python. So the secondary goal I have for this project is to generalize and open source the Python code. If you're interested in that, you can find it at the GitHub link in the description. Currently, I've created the universe and trained the model, and that's taking under 100 lines of code. So you can do the same thing for yourself. Train models, see what features aren't important. Basically, go through the same process I've gone through, but you don't need to worry about writing any code. So that you can get here. So you can get that here, download it, try it out for yourself, let me know how it goes. Fork it. It helps me out if you watch the repository, follow me on GitHub, and star the repository. All those things really help me out. But if you're generally interested, you can get it set up here. I have one requirement on this project is it needs to be all free data, because personally I don't want to use something if I immediately have to pay for it. And in the future, I'm going to upgrade it so if you have some better data source, you can incorporate it. But right now, it's all free data, and all the features are only for price data. So this is where I was at. I started this at the end of last year. So this is where I was at the end of January. I had a model working, but it was basically too fragile to implement. So I needed to go through and iterate rapidly, try all sorts of different strategies to find something that worked. Before I could do that, I needed to clean up the code base. So I got this cleanup done by the end of February, and that really made it so anyone can use it. Now, as I've been adding new things, I'm just updating the code base as I go. This is all the features that were originally implemented. I've implemented more since then. I then went through, made sure everything was working correctly. All of March, I basically was hitting my head into a wall. I realized I was defining the universe the wrong way. I realized I was defining the model in the wrong way. I was using the wrong features. I incorporated sectors. That actually improved. That didn't improve things, it turned out. And finally, at the beginning of this month, I arrived at this model, which I thought was really good for the following reasons. So I'm looking at the metrics in the red box. The first metric is the information coefficient, which basically tells you the predictive power of your model. The higher your information coefficient is, the better you are at predicting. Um, and I'm shooting for a goal of 0.01 to 0.02 because the stock market has a notoriously low signal to noise ratio. So if you're getting 0.01 to 0.02, this is kind of the standard for something that works. You can see here I'm getting 0.047, so well above the threshold I'm looking for. These next four metrics are giving the stability of the model. So information coefficient, predictive power, these next four stability. So standard deviation of the information coefficient should be 3 to 13 times the information coefficient. It's right there at 3 times. Information coefficient to information ratio on a daily basis should be 0.03. You see here it's 0.3, so larger by an order of magnitude. Same thing for a yearly basis, should be 0.3. I'm getting 2.27, so again, larger by an order of magnitude. In the T statistic, I have a goal of 1.98. I'm getting 3.76. So on all of the metrics, it's either hitting the goal or outperforming the goal by a significant margin. The next thing to look at is the decile analysis. So the bottom decile, your lowest predictions, should be the worst returning. You see that here. The top decile, top 10% best predictions should have the highest returns, and in between each decile it should be monotonically increasing, which just means that each decile should be higher than the previous decile, and that's exactly what we see here. So this strategy looks really good on the metrics, and it looks really good on the decile analysis. But this is a single model trained from 2011 to 2019, validated. That basically means tuning the high-level hyperparameters of the model between 2019 to 2022, and then it's tested mid-2023 through the beginning of 2026. So next I did a walk forward analysis to look at how to, if I train a new model for every year, how does that perform? So instead of going back to mid-2023, now I'm able to go back to 2016 and look at how this strategy would have performed. And basically I want something that performed really well from 2016 through 2020 through right now. And then if it's consistently well performing, then I can be confident in that. So this is basically the problem I was having, though. It was really easy to generate a good portfolio on this model. You see in about 2.5 years, it gave 300% returns. Sorry, that would be 200% returns over 3 years. So on average, 60%. Here, average annual return 40% per year. That's really good. Really easy to implement a strategy on these later years. One thing that's concerning, though, is the worst drawdown. The drawdowns get worse over time, so that's concerning. But the model's growing over time, so once it's grown 200% and you have a drawdown, that's going to look a lot bigger relative to what happened initially. But then this is basically the problem I was having. When I implemented it from 2016, it lost money from 2016 through the end of 2021. And it only did well, really, from the end of 2021 through the beginning of 2026. So that was a problem. I also found that if I optimize the model, so I optimized from 2016 through 2020. All improvements at once. Yeah, so this is the optimized model. So I optimized it from the beginning of 16 through the middle of 2018. You can see it did pretty well in that region, but after 2018 through the end of 2021, it did pretty poorly, and then it flatlined, and it ended up negative. So that's obviously no good. So I was looking at how this model was trained, and basically if you look at the decile analysis for each year of the model, it actually wasn't performing that great in all years. You see 2018 obviously looks bad. 2016 looks bad. So I thought maybe this is my problem. Maybe the model just isn't good enough. So um, I tried removing all features that had a low coefficient of variation. So basically, they weren't important to the model. And when I did that, I got this decile analysis. So you'll notice a couple of things. One, it looks better. Like in 2016, it's not perfectly monotonically increasing, but there's not that weird behavior we saw before. This looks basically a lot more stable, and there's a little bit more spread between the high and the low. Um, and so this model looks better. And then when I try to implement a simple scaling, it's actually not that simple anymore, but it's a HRP. So I'm basically taking the top end longs and shorts and then using hierarchical risk parity to size the bets. And then I'm scaling down the portfolio exposure when volatility is high and also when there's a big drawdown. So if the model's down a lot, I'm scaling down the exposure. If the volatility is high, I'm scaling down the exposure. Do you work as a want or what? I'm assuming you mean quant. Oh yeah, there we go. No, I don't. This is just this is what I do for fun. Because I want to be rich. So my hope is I can get this model working, get a good portfolio strategy on it. You see, I'm not far away. Basically, the improvement here is whereas before I was getting negative reliably from 2016 through 2021, now I'm getting positive reliably from 2016 until the COVID crash. I suffer a lot over the COVID crash and the recovery. The model's really suffering. But by the time the beginning of 2021 rolls around, it's back to positive. So it really only did poorly in 2020, COVID and the recovery from COVID. So if this is a lot simpler problem. Before the problem was, 26. The first 5 years I'm looking at, it's going negative, and then it does well after that. Now the problem is I have a really good model, except for the COVID crash. So if I can get some logic to the portfolio, which will prevent the COVID crash problem that I'm having here, that would basically make it so that this is usable. So that's what I need to look into now. So I'm basically using a bunch of technical indicators. You know those charts people look at where there's all those things like the rolling average, MACD, uh, volume, relative volume. Uh, Let me show real quick. Trading view. So if you have something like, let's say you're looking at Apple. How do I pull this up? There we go. Full chart. And then if you put some indicators on, like this volume here's an indicator. Let's put on so there's an oscillator. That's an example of an indicator. Bollinger Bands. These are just very common indicators. I don't have all of these. Uh, moving average crossover. Yeah, I'm not paying. But anyway, you get things like this. So you're getting Bollinger Bands. Mostly it's calculated on the log returns. But basically, you're inputting these sorts of features. For instance, the low of the Bollinger Bands, the mean of the Bollinger Bands, the high of the Bollinger Bands. So every day it knows, what's the um, low for the 30-day Bollinger Bands, going up to data from the previous day, or what's MACD, average MACD over the last 30 days, something like that. So it's taking these technical indicators. Also for different time scales, you want some short-term indicators, long-term, medium-term, and so I'm doing different time scales. Yeah, well, that's what I'm using in my model. Basically, every technical indicator I could find from price data, and then I'm doing a short term, medium term, longer term, and ultra long term. Um, I put those into the model, and I'm predicting the Sharpe ratio, and that's how I got this good model here. Um, but that I decided wasn't good enough because I wasn't able to get positive returns since 2016. So then I went through and looked at did an analysis of all of the features for the model, and how are they correlated with the actual, what really happened, what I'm trying to predict, the forward Sharpe ratio. And then I removed everything that had a low coefficient of variation, basically everything that wasn't important for the model, and that's how I got these new features, um, that are going into this model, and that's basically what's training this model. You put in the features, put in your target, and then the model optimizes on the training data. It also uses a validation data set. So validation data runs through and finds what are the best hyperparameters, things like learning rate, stuff like that. And then it goes to the test data, and then optimizes the model to predict the test data, and then, or sorry, the training data, optimizes the model to predict the training data, and then you have the test data set, and you say, okay, with the optimized model, how does it perform on the test? And so this is all how it's performing on the test. So this indicates that since it's monotonically increasing, bottom decile is lowest, top decile is highest, typically, then I conclude that this is a good model. So this is how to improve the portfolio strategy. You've successfully stripped away the illusions, data errors, and over-optimized parameters to reveal a strong, consistent strategy. I've run face first into the 2020 COVID trap. I can tell you exactly what happened by looking at your gross exposure. Because your gross exposure was pushed down to 25%, the moment you cross all-time high, the drawdown scaler released you. Peak nav. But if you want to make the model for yourself, just go to the GitHub. You can get it. Well, machine learning, I don't know. I've kind of just used it for work. So I got good at it with that. But this project has really made me so much better because it's constantly, what model should I use? People comment what to do. Like some guy commented back in January. He says, why aren't you using light GBM? So I looked it up, and that's kind of the industry standard, so I started using that. But yeah, you can go to the GitHub here. download it. There's instructions for getting the data set up. Once you have all of that set up, you can basically go through. I'm making the model in universe in under 100 lines of code, so you can easily do the same thing. Um, so yeah, what does nav refer to? Oh, net asset value. Um, so solution one, use a rolling nav, rolling peak nav. Um, so if total nav is greater than peak nav, so this is model 23. Um, well, I mean that. So it's. I mean, you could easily kind of tune any sort of strategy to work well over certain time periods. The hard thing, basically, what's happening is this COVID crash, though, is causing a problem. So, although the returns are ridiculously high, 4x returns over 10 years, you would say, well, that's, the best model ever. Um, but if you look at like the COVID period, it basically went negative 2020, and it didn't recover until the beginning of 22. So it took, I would have spent 2 years below water. So although the returns are really high, it's also wouldn't have been sustainable. I don't think. I mean, who would keep running a model when they're underwater for 2 years? Um, so the returns are really good, but there's this drawdown that's bad. So basically, what I think the trade-off is going to be that happens is to minimize this drawdown and make it go positive no matter what. I'm going to have to sacrifice the overall returns. But if I could have, if the worst drawdown could be like a month, um, that would basically make it way easier to actually implement this model. So once I have something that's working, I have a feeling that the overall return should be significantly worse. Okay, let's make some updates to the code because I've changed so many things. Okay, so that looks better. It never goes negative other than sometime. Let's see, when would this have gone negative? So, poorly in 16. It did well, but then it took a big loss here, recovered it, went positive, took a big loss in COVID. And again, took a while to recover, but it never really went negative. Still took like 2 years to recover. Okay, so what if so 252-day rolling peak, what if I change it to a 6-month rolling peak? Six months, no. Just do 100 days. So let's see. Drawdown duration 551 days. Here it's 573 days. So I didn't improve the duration at all. It got worse, but I did improve the net return. Annual return here is good, 22%. No, it's everything in my universe. So it's all real estate investment trusts, ADRs, which are foreign stocks listed on the U.S. market, and common stocks like Apple and Tesla. So using a shorter period for the drawdown didn't improve things at all. And just for consistency, let's do 60-day rolling peak. 50-day. So it does worse in earlier times, but that because it's constantly limiting the exposure. Probably the exposure should go to 1. Um, but one nice thing that's happening is this is getting smoothed out. So, it never drops below 20% after COVID. Um, but I can't tolerate that big COVID loss. No, I do swing trading, but I'm not a professional or anything. I had, earlier this year, at the beginning of the year, I had a silver trade that did well. I bought at like $65, sold at, I think it was $85. So that went really well. I'm also big on Bitcoin, and if you like Bitcoin, I like to pay attention to the Bitcoin cycles. Um, and I'm really into those, and I really believe in them. It has a pretty proven track record. So I bought a put on IBIT, the BlackRock Bitcoin ETF, um, earlier this year in January when Bitcoin was at $91,000. I bought the put and then I sold it when Bitcoin was around 70,000. So that did really well. Um, and then I had a play on oil. Uh, at the beginning of March, I didn't see any way the Strait of Hormuz was going to open. Um, so I bought some oil and I rode it up and I rode it back down and then sold it for a slight loss. So that was always the problem with that oil trade is I didn't have an exit strategy, and I didn't define one before I ran out of time. So, but I didn't want to sit there and ride it out through, um, the end of things. So, fine, I figured. Um, so adding the 252-day rolling peak does improve. It doubles the returns basically, because my exposure's higher, I'm assuming. Although it doesn't seem, I guess it just goes higher in 2021. It goes high earlier. It looks a lot noisier. Um, yeah, probably I should lower the scaling from volatility. Yeah, but that's what makes COVID so useful. Is if, with this, if I were to implement this strategy right now, I would basically be saying, hey, okay, this is a really good strategy for relatively stable markets. But if something like COVID happens, it's going to kill the strategy. So I'm always going to be paranoid. I always have to be looking out for that. And if, when another COVID like type event happens, was pretty unique. It's a 100-year pandemic. But there are things that happen where, businesses get shut down and stuff. If that sort of shock happens again, um, and the model is not performing well, then I'll be in trouble. If I can get a model which has less overall returns, but it does well no matter what, through the low interest rate, low volatility regime in the late 2010s, it does well through the COVID crash, and it does well, on everything since, through the tariff crash, through the recent Iran crisis. If it's doing well through all of those, then I can be extremely confident in the model and say, hey, this strategy hasn't broken since 2016. It has a 10-year track record. I can go ahead with that. I'll be a lot more confident in that. Otherwise, with this strategy, if I try to just avoid COVID, I don't think I could tolerate a 3% or 30% drop in a month. Um, that's just emergency territory. So, um, basically, no rolling peak did improve it. Or no rolling peak, it was here. Adding the 1 year rolling peak did improve it a little bit. 100-day worse, 50-day worst. And actually, this 252-day rolling peak gave the highest returns as well. So I like that. Um, so use conviction scaling. True. Conviction look back. Make it 5. Change this back to 252. So now this is with a 252-day look back, and does shorter conviction look back improve model? Portfolio strategy. Whoa. the hell? So why does exposure go to 0? Okay, I'm gonna go to the bathroom really quick. I'll be right back. Okay, well that seems to have fixed it in some sense. So it never goes negative. Drawdown duration still 600 days. But the drawdown is prolonged more. Slightly. Hmm. Okay, so I'm at about an hour. This will be the next thing I implement tomorrow. But it seems like I'm well on the path. You know, this most recent strategy never goes negative. We're almost at double the portfolio value after 4 years of trading. The COVID happens. It takes until mid 2022 to recover. So that is a longer time to recover from COVID, right? No, mid 22 no matter what. But then it flies up to give 8x total returns. So we're on the right path. I just need to keep hitting my head against the wall. My problem's gotten a lot better from two regimes, later regime it works well, earlier regime it works bad. Now I have it working well no matter what. I just need to fix this COVID problem. So if I can mitigate for the COVID crash, I'll be confident that I have a good model and I can go ahead and start paper trading for a month. After that, if that goes well, I'll go live. So that's it for now. Thanks for watching. Have a good rest of your day. Adios. COVID crash, I'll be confident that I have a good model and I can go ahead and start paper trading for a month.